Hello and welcome to another ACY Securities vodcast. Today I am with veteran trader Mike Moran, who has spent nearly 43 years in the financial markets. He's done a lot of things along the way, including economic reporting and writing for a variety of different companies. Thanks for being on the show today, Mike. It's a pleasure to have you here.
Well, thank you for having me, Alistair. It's a privilege and a pleasure to be here and speaking to you.
Absolutely, I'm going to enjoy it. I'm sure you will as well. What are you doing today? You've done a lot of reporting in financial markets. Is there any crossover or similarities?
Not really. I think at the moment I'm working as a responsible manager in compliance.
Yep.
Compliance is something that I took up after my trading and sales life, just for something to do. As a compliance responsible manager in compliance, you're not actually a full-time employee of the company.
Yep.
So you're like a consultant in that sense, and it sort of suits me. Up to a few weeks ago, I was writing for financial market commentaries.
Yep.
Mainly on currencies, on the foreign exchange markets, and particularly on the currencies that I used to trade, emerging market currencies, but that includes all the major ones as well.
So tell us a little bit more about that. When you're doing all this sort of writing for the currency side of things, is it coming from an analyst's perspective or is it coming from a trader's perspective? What would sort of way were you trying to sort of make these reports, and who were they going to?
Okay, they're going to mostly retail guys in the market, these publications, or there was a time I was writing for one of the brokers as well.
Yep.
So they're going mostly to retail guys. What I do is I actually trade myself.
Yep.
And I find that a lot of guys out there in the market want genuine views. So I write what I trade. Basically, that's the way I do it.
So
sometimes I can be totally wrong.
Yeah.
And
we all are at one stage or another.
Yeah, and it's in my writing. You could see it's totally wrong as well. But
yeah.
I feel, or I believe, and this is from the old days, that people would rather hear a strong view, even though it's wrong, rather than a wishy-washy view.
Yeah. Okay, so I mean, I suppose we really want to sort of get to the crux and sort of see where you sort of come from. So how did you actually start investing?
Okay, I started as a broker more than about 45 years ago. I'm originally from the Philippines, and I started in the Manila market. From there, I went into a bank as a trader. I got to befriend a lot of the traders. I went to a bank as a trader, and I moved out of the Philippines into Hong Kong, and then from Hong Kong came to Australia, and worked in a variety of centers in Asia, in Tokyo, in Singapore, and then here in Sydney. So that's the basis of my career. I started trading when as an assistant traders.
Yep.
They give you a limit in these banks, the way they used to do it.
So it's not like a prop desk. It's more, you're on the banking side of things, weren't you? So it's very different in how that sort of worked when you were starting out. In
a sense, it was part of the bank, but every bank then had a trading room.
Right.
So sort of like a treasury.
Yep.
And you were taught two things basically. One was foreign exchange, and the other one was money markets.
Yep.
So at the time, where interest rates, there was a wide divergence on interest rates between countries. Money market was quite important.
Yep.
And it went hand in hand.
So
with
what was your very first trade?
My first trade was 500,000. At that time, the pound was worth more than $1. So
okay.
It was £500,000.
Yep.
I think it was about 245 or 250, somewhere there. There was £500,000 against the US dollar.
That's
because it was a British bank.
That's a very big trade compared to most retail traders would be used to, including even on some institutional scales. That would be like, well, that's a lot of money.
Yes. Yes.
So how did it go? Was it a profitable trade for you?
Yes, it was profitable. It wasn't a big profit. I was very conservative then.
Yeah.
And the bank at that time because it was a small branch in a Manila office, and every trader had limits.
Yeah.
You know what you could lose, how much position you could take, and we stuck very strictly to those limits.
So what would happen if you were to go over one of those limits? Would that mean the bank would cut you off for that day and you wouldn't be able to deal with those funds anymore, or how did that sort of operate?
Basically, yeah, you got to wrap around the knuckles. You were told to stop trading, and I think just the shame of it all that you actually went against that, and they're quite liberal.
Okay.
There was a time when we got caught trading overnight and had to stay overnight, and the next day the branch manager came in and found out what happened and told us to go home for the day. We had the limits cut for a while and then sort of built it back up again.
Yeah, okay. So, okay, well, I mean, that's a very different take. I'd love to sort of explore that a little bit more further down in the interview. But, what's your current sort of take, like, what are you currently trading or investing in? What's your preferred sort of asset class now?
It's still foreign exchange.
Still foreign exchange.
I learned a little about stocks and the equity markets in the past 5 to 10 years.
Yep.
But I always go back to FX.
So it's kind of like what you stick with sort of thing.
Yeah. And it's like kind of second nature. You're always wondering, during various times during the day, where's the euro? Or I'd see something on TV.
Yeah.
Like COVID cases are going up in France. Oh, where's the euro? Right away you'd relate it to the currency. Or there's protests in Thailand because of the king.
Yeah.
And then that would go to an emerging currency.
So
what would be
you're really looking more
Thai.
at the political scale of things that affects the currency or the central bank action.
Yes.
Okay. Well, what's your current? Okay, thinking about today then. Yeah. What's your current view on the global markets and more particularly in currencies where you're focusing most of your trading time in?
Well, I think in the currencies, because of the interest rate structure and because of the way the Federal Reserve Bank is going, the dollar is under a lot of pressure.
Yeah.
When they keep printing money, even as we were talking about earlier, that puts the dollar under a lot of pressure. There's less demand for it. But at the same time, I have the feeling that, particularly going into the year end and into this election, that the market is also very short of dollars. The market's actual position is getting overstretched. The short dollar trade, while it's still a good trade, is overstretched. Sort of maybe like the share markets, the equity markets.
They're a little bit overextended in some instances.
Yeah.
So, okay, this is sort of a bit off the cuff, but I mean, when you're thinking about the current levels of US stimulus, do you believe that they're going to continue to keep pumping that in? In which case, if in my mind, if they continue to keep pushing more stimulus out, that just devalues the currency further.
Yes.
Do you think there's really a risk of debasement then that could ever potentially occur? I mean, I've looked at this a fair bit, and I just want to get your sort of opinion on that because there's a lot of articles you can read out there, and a lot of personalities that will say, oh, well, we've got a risk to the US dollar being debased now. But my question to them has always been, what are you going to replace it with?
Exactly.
Exactly.
That issue has come up time and time again.
Yeah.
And I came from that school where, when there was a risk off, everyone would go back to the US dollar. And again, what would you replace it with?
Yeah.
That's a very big question, a very good question. I don't have the answer to that.
No.
So at the moment, I don't think the US dollar is about to be debased.
No, I don't think that's a plausible possibility at this point in time. And I can remember even writing an article sort of saying, what are the other options that are out there and available? But there's really not much that could really take over as that dominating force. We all compare currencies to, that would shift a lot of different things in probably the wrong direction almost overnight. Now, one of the questions I like to ask all of our guests on this program is about their experience and their history, and it's more specific. It's a little bit interesting about the idea of if you had a time machine and you could go back to 1977 or at some stage in your trading career and give yourself the wisdom that you have today, what would be the one thing you would go back in time and say, hey, here's a note from myself, or you send some sort of fax and ask, tell them what they need to do to make their trading career better.
I think in my case, I would probably at that time in the markets, it was all about relationships.
Yeah.
So it was about the broker-dealer relationship, dealer to dealer. So your knowledge and your insight into the market was your relationship with other traders.
So with that time machine sort of question, I mean, you're saying sort of now that a lot of the beginning of your career was all founded on that relationship aspect of what you can build with traders, with brokers, with whoever it may be. What about on the trading skill side of things? Would there be something that you would tell yourself to improve in one particular area?
Knowledge is always an area of improvement.
So to be sort of just consume everything you can, and establish what works and learn as much as possible.
Yeah, and I would work both sides of the equation, because there's a lot of technical analysis that's going on today, and people use that mainly because they feel it's a much better much better tool. But fundamentals are very important. You mentioned earlier, particularly in other countries, politics can play a role as well. I mean, we have the U.S. election coming up. We know what happened in 2016 when President Trump won that election, and from November to January there was a high period of volatility in foreign exchange. Yeah. So yeah.
I mean, for me, I kind of find that when I've had students in the past, and even when I first started learning to trade, I mean, I started with technicals and I've migrated my way through from technicals to fundamentals to being something that I call a bit rational, where I use a bit of both. But for me, I think the most attractive element of technicals is that they're black and white. Yes. It's you're in a trade or you're not. The signal is a yes or it's a no. And you can literally put movers or markers or whatever it might be in a trading plan that says, if this crosses this line, then this MACD does this, or this trend line does this, then I'm in for a position. When you get to the later stages with a little bit more discretionary trading, I suppose, even if you're doing technical trading, but from a discretionary side of things, we're using more patterns and candlesticks, it becomes a little bit grayer. And the further up the chain you get until you enter into the fundamental analysis, once you get there, it's like 95% grey, just like life is. So, so it makes it a little bit harder to do. Now, one of the other questions we ask every single guest is, we ask them to sort of inform or give us an idea of what they would do with money when they had it. So if you had, in three different instances, $10,000, $100,000, and $1 million, how would you invest each portion? And if it differs, why is it different?
I would still look into currencies.
Yep.
The difference would be the bigger amount of money that you had. To say, 1 million versus 10,000, or a smaller amount would be obviously the bigger amount you have to throw into the markets. The more the more you can actually lose. Yeah. The more you can risk. Yeah. So then you would build your risk parameters around that. Yeah. So I mean, the one question there that I sort of have to go to straight away is, I mean, a lot of traders will use a 2 or 3% rule of thumb for their risk. Would that risk factor remain the same on the million versus the 10,000, or would you be changing those parameters? I would make it the same.
You'd make it the same?
Yeah.
Okay. So if you're going on that sort of number, I suppose one question would be, like, if you had the full million, would you invest maybe 50% of it into property or into equities or something else and diversify it, or would you just stick it wholeheartedly straight into FX because that's what you know? Good
question. I would probably stick it into FX.
Yeah, the whole lot.
The whole lot.
My man. I like to hear that. That's how you play. Okay, so I mean, from there, the strategies obviously doesn't really change for you because you're sticking with what you know. It's what you've made an income out of. Now, something that's a little bit further stretched. This generally comes from more wanting to gauge a little bit about who you are, and so that our listeners can really see what's sort of going on. What's the last book or TV show you've been watching recently? Is there something that's been trading related, or is it just something to take your mind away from trading?
Good question. As you know, because I recently had heart surgery, I've read quite a few books, actually about 6 or 7 since then. I like reading about mainly, I like trading books.
Yeah.
I just reread Market Wizards by Jack Schwager.
Yep.
I like reading books about football, soccer,
Yep.
coaches. I read Alex Ferguson's book.
Because you used to play soccer, didn't you?
Yes.
You played for the Philippines.
Yeah, for about 10 years. Yeah.
For 10 years, you played in the national team for the Philippines as well.
That's right. I coached a bit here too. Yeah.
So not only professional soccer player, professional trader, money man. Oh,
yeah. And,
everyone, Mike Moran.
There's one I read recently about a soccer coach, Pep Guardiola. So it's called Pep Confidential.
Yeah.
And it just gives you an insight into what coaches think, the way they motivate their players. So very interesting reading.
Do you take any of the stuff that you might have learnt from football and apply it to your trading? Is there any techniques there? Is there any coaching side of things that you might use for your own trading days? Is there anything you can think of that has crossed over for you?
Yeah.
Yeah?
When in doubt, kick out. So when I'm in doubt in the FX as well, I just square the position.
Yeah.
And in the football, I guess we used to talk about it a lot. And being such a small country, and our team was always playing defensive.
Yeah.
So when we had any doubts, we just kind of kick it
it
out.
out.
And they just waste the time.
Okay, so that's a little bit different. Well, what's your what do you think to date? What do you think is the best trade you've ever had?
All right, there's a few of those. I think the best trade I just had to think about it before our talk was actually it went from a negative. The biggest loss that I had in my career. You know, in the old days, you would come into the trading room for the budget. You had budget nights. So this was in the mid-90s. I was working for Lloyd's Bank, and I was the Aussie trader.
Yep.
And so you would come in at night when the budget was given, and basically I started off with a wrong position, and I just
So you just sort of walked in, you sat down for your shift, and you've been handed. Yeah, you've been handed, some bad trades, and gone, okay.
Or you quote a customer.
Yeah.
And he gives you, and it's just going down, and then I was saying, well, the budget's good, the currency's going down, but sure, the budget's good. I'm going to stick with this, and sure enough, I was in the trading room up to midnight, and at that point I had accumulated maybe about a 35 or 40 million Aussie position. And I was down $500,000 US. Yeah, and the manager said it was midnight, go home.
Yeah.
And my dealing room manager was very supportive, and before he left, he said, "Look, we gotta do something about this." And I said, "Okay." I lightened the position to about 30 million Aussie, and I said, "Well, I noticed we both agreed he's a Kiwi,
Yeah.
and the Kiwi hadn't moved as much, so why don't we hedge by you're long Aussie by going short Kiwi."
Yeah.
So we went short the same amount of Kiwi, about 40 million Kiwi, 30 million Aussie, and I kept the Aussie Kiwi position for the next 3 days. In 3 days, I got out flat.
Wow. So it's
Yeah,
basically
so just
turned around you've been handed a bad scenario from the trading floor on the bank, and managed to get out a very big position into a profit, or at least a break-even sort of scenario.
Yeah, and that was a big lesson for me.
Yeah.
Yeah,
Okay.
yeah.
And what do you think has been your worst trade that you've had?
Okay, the worst trade was something I had no control over. My last job, I was handed the emerging markets portfolio.
Yeah.
So you're given about 30 currencies to manage.
Yeah.
You could trade any of the majors, but you've got all these other little currencies from Papua New Guinea Kina to Fiji dollar to South African rand to some of the Latin American currencies. And there was a time when I had to keep a long balance of Fiji because you had to keep your nostro. You had to have money there, or they would penalize you.
Right.
And
so was also a compliance or regulation thing at
yes.
the time?
And I wanted to. At the time, there was a lot of rumors going on in the markets about Fiji, and I used to pay attention to all of this because they had a lot to do with something happens politically in those countries. the currency is going to move. And there were all this talk about coup, and Fiji's had a few of them. And sure enough, I wanted to hedge that or just cut it out. But my boss said, no, you stick with your nostro. And sure enough, overnight they devalued by 20%.
So it's, you wanted to actually hedge the position.
Yes.
But you weren't being allowed to by the sort of higher up.
Yes, and the other one was, how would you hedge that position?
Well, that's...
I'm
not quite sure what you hedge the Fiji
Can
dollar
you go
against.
short Papua New Guinea kina or something like that?
Look, that's probably the best guess to go, but I would have thought those just sort of have a similar relationship. They move down at the same time.
And you can't just trade those currencies physically.
No.
Yeah, there are regulations and.
I mean, I suppose that's why when we look at emerging market currencies, that's why they are so volatile.
Exactly.
A lot of it's driven from political side more so than the economic side of things. Well, I mean, I suppose the next question that leads off the back of those, in both instances, what did you learn from it? And did it change how you traded after?
Yes. I became a lot more risk averse as I got along further. Instead of being so gung-ho, I think I was already toward the end of, I knew I was toward the end of the career in trading. And you could see the markets were developing into a sense that they were becoming different. The banks were becoming different. And so I was a lot more risk averse, but I also decided that, it's never too late to keep on learning different things, different markets, and about different countries. Just keep on learning. So that's what's changed. Even though now, when I am trading, I'm very conservative.
Yeah.
Again, the 2 to 3% with very small amounts in various currencies is what I do today, and that's mainly to keep my interest alive, because I have that desire to trade foreign exchange, and also it gives you something to write about.
Yeah. So it's become sort of, it sounds like the further you've gone on, the more you've learned, but the more risk averse you've actually become. Yes. So that's been it almost sounds like you've become more of a risk manager than a trader in that front. But that's what we all do. We're all in that industry of preserving capital and minimizing our risks versus making the big bucks with as much cash in it as possible. So, which makes a very big difference between, I suppose, a gambler and what you would consider a professional, a trader, an investor, which all think in very similar sort of, even business owners think in that same sort of way most of the time. Now, I mean, I suppose I want to start looking back at what it was like when you first sort of started trading back in the 70s. So when you were sort of back there, what was it actually like when you first started out? We heard that you sort of got into a broker and you were working on bits of trading floors here and there. So tell me a little bit about what's happened behind the scenes there.
Okay, during that time, again, I can't emphasize how important it was. All about relationships. So as a broker, you were assigned a certain dealer from a certain bank. You built that relationship up. You gave him the prices, and depending on his amount of confidence that he had in you, he would give you business. Everything else being equal, the pricing and all that. During those days, people weren't as price sensitive as they are now, because you had spreads, for example, for a set amount of $5 million US in, let's say, the Aussie or the Q, you had 10-point spreads, which went down to 5 points.
And so who would have been the sort of key client as a broker back then? Because today the internet's made it so accessible, and computers have made it so accessible that almost anyone can open a trading account. And if we actually look at trading volumes in the last 2 years, there are some days this year where we've got 30 times the highest amount that we saw last year, which is indicative of how many new accounts with like Robinhood and things like Self-Wealth and Stake, all those sort of mobile platform things happen. So I'm curious to see, is there a massive difference between now and then? I think there probably is, but what was the client like back then compared to now?
Okay, your client base was the banks.
Yeah.
They were the big banks.
Yeah.
In foreign exchange, the cities, the Deutsches.
And they're really looking at, the FX rate and sort of controlling or minimizing their risk, not using it to be profitable, although if they did, they'd be quite happy with that solution.
I think so, but at the same time, they had a mandate. Each one of these banks had dealing rooms, and the aim or the purpose for these dealing rooms were to make money. One was to quote their customers first.
Yeah.
Make sure that they got good prices. But they were there to make money, and they built these dealing rooms. They had training programs for all the traders. During those days, you had actually a proper training program.
But it's very much a more institutional
correct
trading than
yes.
than what is easily accessible now. And back then, a retail person wouldn't be really able to open an account. You'd end up on the bottom tier needing a fair amount of dollars to do it,
just
right?
Just the limits.
Yeah.
The limits alone. Yeah.
So, obviously, the bigger the trading account, the more you change the sort of style in what the objectives of that trading are. What did you find is different with your own trading compared to what happened then? Other than obviously the risk profile, is there anything that sort of you still think you take some of those principles away from how you're doing it then, or are there some things you would just reject entirely?
I think one of the big factors about being in a trading room would be like the two of us. We're actually in a trading room and we're talking about the currencies. Well, what do you think? What do I think? Oh, this is and you would tell me, Mike, this is a level where there's strong resistance here. The technicals are telling me this.
Yeah.
And just this two-way conversation, you can't have that with a portal or a machine or an algorithm. You just can't have that.
No, I agree, and I think that's. Being someone who's been on sort of, I suppose, both sides of the coin. I've worked in trading floors, but I've also gone out on my own before. And the one thing that I've always noticed is that exact same thing. I find my trading is better when I'm in a team.
Yes.
And when we're in a team, because you might have an idea about something, but you kind of go with the democratic rule of, okay, well, if 3 people agree with it and 3 people don't, you go, okay, well, this isn't the right trade to take.
Right.
And you will also sort of bounce ideas off each other, and one person, you won't have to cover the entire market.
No.
You can focus a little bit further down, and when someone else notices something, everyone jumps on that and goes, okay, let's have a look at this. What's everyone see? Yeah. And it's that conversational piece. Not only that, you learn how other people go.
Yes.
I think the big one for me on that front has actually been it's important to have people from very different backgrounds.
Yes.
So whilst you might all be traders, you want someone who's more on the fundamental, someone who's on the technical, someone who's a quant, sometimes someone who's a statistician, or maybe even some other form of analytics that is going to be more relevant to what you're doing on the day, because it enables you to sort of just get this broad base of understanding. If you put everyone in the same room with the exact same skill set, you get the same answer every time. So you don't want that. You want people to have differing opinions, in which case it lets you sort of bounce and get better results. I like that. I think that's probably one of the big things I've found. I suppose it's one place that you and I have similarity in that I suppose I'd call myself new school and I'd call you old school, but that's a very big thing.
Yeah, for example, like in Australia, you had the big 4 Aussie banks.
Yeah.
They say, I just give an example of the Commonwealth Bank, the trading room. Yeah. They had one floor and there's like 350 positions around on Sussex Street. So that whole floor was all these kinds, like you said. They had quant guys, they had they had salespeople, they had the spot forex and the forwards, the forward and the interest rates and the bond desk. And
but having worked in sort of similar sort of environment to that, I tend to find that you've got a team of quants.
Yes.
Team of
FX.
A team of FX, a team of things. And so you're sort of grouping guys in category.
Yes.
Whereas personally, the best team I've worked in has been where there's only been maybe 5 or 6 guys per team.
Right.
And you're all from a different background.
Yes.
And you might have multiple teams, all focusing on different markets or some specialization, but they all have, each individual member has a different background.
Right.
Versus when I've worked in ones where you've got quant team, dealing team, trading team, FX team, stock team, commodity team, whatever it may be. Right. You don't get as much, how would you put it? You don't get as much of that integration between the teams because they focus on their one element only. Put one member from each place in you end up, it's like chucking a stone in a washing machine. Right. You put the stone in uncut, and then you pull it out and it comes out all smoothed out and polished because it's gone okay. Now, I mean, you mentioned before that the relationships for the broker were a major part about, the trading process. And of course, that very early days, the relationships were the big thing. And you've already sort of said how important they really were. But do you think they differ today?
Oh, definitely.
So what do you find is different between then and now? Do you find that relationship is a little bit less, or do you find it more pushed the other way?
If any at all, there's hardly any relationship.
It's much less personal.
Much less personal.
You can sign up online.
Yeah. It's like, for example, 2020, COVID and Zoom, versus you and I meeting. Let's say in a church context, like the local church that I go to, meeting in person, actually going to a service is totally different from doing it on Zoom.
Watching on Zoom, yeah.
Yeah, every Sunday. So that's probably
and I suppose that social interaction face to face builds some level of trust.
Yes.
Where you can actually have discussion, or even just the phone call. Whereas when it's a Zoom session, it just doesn't break that. And I think that is one thing. Is you're right. The working in that team environment improves your trading. Yes. Working on your own and talking to someone on Skype doesn't quite give the same sort of result. Well, I mean, outside of that, I mean, after you've sort of considered that sort of thing, you said you've worked in both money markets and the FX. Do strategies change between the two?
Yes and no. Money market at the moment it doesn't exist anymore. It hardly exists.
Yeah.
But at the time, because interest rates were moving so much, against one another, they would have a much bigger effect on the currencies and the way they would move. So you wouldn't have all this, the dollar's just going one way. You'd have dollar against the Deutschmark and then against the yen. Okay, they would still have one direction for the dollar, but you'd have it to varying degrees. So,
okay.
Yeah.
So, I mean, if that's the case, and we don't see money markets much these days anymore, why do you think that's occurred? Is it because it's become an irrelevant asset class? Good
question. I think the one is it is probably irrelevant. They probably don't use before you had a money market book, which was basically overnight to 12 months, and then you had a yield curve. Like short dates would be lower and then the long dates would be higher.
Yeah.
Whereas today everything's just sort of flatlined.
Yeah.
And interest rates across the world in the past I don't know how many years.
Near zero.
Yeah, and it's all near.
I mean, even in your bond markets, you've got bonds that have got negative rates.
You can go all the way out to that end as well.
Yeah. And so I suppose in one way, it's sort of been taken over by another asset class that is perhaps a little bit more suitable to today's needs. But even then, if you look at bond markets now, you've got some bonds that are at zero or below zero in yield.
That's right.
In which case, it's like, well, why would you invest? And that typical thing of investing maybe 60% in stocks and 40% in bonds as your hedge no longer works. And that's why we're seeing so much happen with gold. Because when you've got nothing left on bonds, well, the next safe haven would be US dollar, but no one wants to touch that at the moment. So outside of that, you go, let's we've got gold left. Let's try it that way instead.
Yeah, that's right. You look at, for example, 10-year rates between US, Germany, the UK, Australia. They actually all move in tandem.
Yeah,
they're at certain levels and they all move in tandem, and you hardly see any divergence anymore between them. Yeah.
In the last, I call it 8 months since pandemic origin sort of started, the one thing that you do see a little bit of is there's actually a switch between that bonds and the gold, which has been something that's been interesting, and I've been keeping a close eye on it, because if you actually look at gold and then compare it to silver, there's another issue. Gold and silver are 5,000-year-old assets, and for 5,000 years they have had a 16-to-1 ratio, meaning for 16 ounces of silver you can buy 1 ounce of gold. Right now they're over 100, 100 to 1. gold to silver ratios, and it's been like, that's only happened 3 times in history, and it's all been within, you know, the last sort of 3 decades. So
does gold go down or silver go up?
that's what I would like to know. Which one's overvalued or undervalued here? Should we all be buying silver, or should we all be selling gold? What's your take? What do you think?
I think silver is a lot more volatile.
You think silver is more volatile?
Yeah. So if probably gold would be closer to the realistic, you know, where the real prices is, but I don't know. I'd rather be selling gold than buying silver.
Well, I mean, the other side of gold is if you actually account for inflation, whilst we're seeing some of the highest prices we've seen ever in gold now, if you account for inflation, it's still not the highest price.
Right.
That would have been 1975, in which case, accounting for inflation, per ounce, you'd be looking at $2,500. Whereas now it's about 1900, but you know, we've got next to no inflation, so bit of a difference on that one. So I mean, obviously, with you having worked in both money markets, banks, and a variety of other areas, do you find, with predominantly having worked on the banking side I'm looking at here, do you find that the difference between institutional banking and retail banking on the trading side is different? Have you worked in both places there as well?
I've had a glimpse into the retail.
Yeah.
But I've always worked in the institution, because the trading room, the actual physical trading room was always part of institutional.
Yeah.
Now the retail guys are the ones that deal with a lot of the, you know, the cash, the mom and dads, and they're the ones with all the notes and the cash.
Yeah.
Yeah. So I liaised with the
So with that glimpse, what's your take on that? Do you find that it is very different, it's similar, the strategies remain the same?
They're probably growing closer together,
yeah,
between the cash and the institutional.
Well, I suppose, I mean, now if we look at what's going on around the globe, I mean, you know, institutionals are investing in the same things that, you know, the guy that's on Stake or Robin Hood are investing in. They're all trying to get in the same pie.
That's right.
So that makes a bit of sense. Now, moving on from sort of a bit of your background, I do want to have a look at, you know, a couple of things about the trading. I mean, you've obviously traded through multiple decades. Are there any sort of key metrics that have really affected the sentiment along the way that changes your outlook with them? So, you know, I'm thinking more, you know, the 1985 Accords, you know, 2001 and the Twin Towers, the GFC, and now 2020. What do you think in sentiment, sort of from a fundamental scale, has you know, changed the way you trade in any of those instances, or has it remained the same?
Oh, I think a lot of has changed then. You know, the metrics, for example, in 1985, when the G5 got together to push down the value of the dollar, was because the dollar was overvalued, because U.S. interest rates had gone sky high. Yeah. And that was the reason why the U.S. dollar was overvalued. So the 5 countries got together and decided to push the value of the dollar lower. So you're not going to find interest rates back at
that level.
Yeah, that level. And sure enough, in '87, I think it was the Louvre Accord, where they had to push back down
well, I mean, and that's something that
push back up. Sorry, push back up.
And that's something that I've always looked at when it comes to central bank action, right? Most of the time, up until very, very recently, we're talking, you know, in the last month, you know, the U.S. Federal Reserve decided that they were going to stop doing the 2-tiered mandate, where it was in maximum employment and keep getting inflation to 2%. That's something that they used in 1970, 1980, 1990. It's not changed at all, but obviously over the decades, everything has changed. Like, you know, you can't use 1970 strategy for 2020. No. So not only just recently, even then, when they've recently changed this dual mandate that they use, they've gone through to an idea of using, well, we're going to do averaged inflation, which means they can run it hot, but it's still 2% average inflation they're aiming for. So there's not a lot of change that's happened on that front. And then growing, obviously, you know, achieving maximum employment. But to me, both of those counteract each other. If you want to get maximum employment, then you generally end up with your inflation coming up as well.
Yes.
And they've been for 30 years or you know, 3 decades trying to push this down while pushing this up, it's counterproductive to what they're doing, which is no wonder why since the GFC it's been struggle street for most central banks around the world. Do you think that change in sentiment there on that front, in how or I suppose, you could even look at it as their position as being hawkish and dovish, needs to be modified to be beyond just two different types of appeal or two different types of thinking?
Good question. I don't know the answer for sure.
Yeah.
I think they're going to continue to try and do what they need to do.
Yeah.
But whether they can actually change it, it's difficult to see that happening.
I mean, even now, I mean, the Fed is saying 2023 we're not going to raise rates until then.
Until then, yeah.
And they're still aiming to try and get 2% inflation. So, I'm not sure that the change in sentiment's been enough for them to really consider what's going to happen in the next 5 or 10 years. And I think there's a big difference in how people were thinking in 1970 and how they were trading in 1970, including how the central bank was thinking, to even just the GFC. And I think between the GFC and now has been this old style 1970s central bank action that we've seen. That's it. They've gone, this is a problem. Yes, it's the opposite of what we've got, but it's all we know.
Right.
When it's come to 2020, now we're seeing we've learnt mistakes from the GFC, and we're trying to push as much capital into it. But I suppose that you could have a whole podcast just on that.
Yes.
Okay, so I mean, in that instance, the other parts that have really changed, I suppose, between back when you first started and now has obviously been the accessibility to trading accounts, but also news.
Yes.
So do you find that with the amount of information that's available now versus back then, is it easier or harder to really decide where you want to go with a trade?
I think it's actually more difficult. It's actually harder.
Because you've got so much. You get so much information at once.
Overload.
Analysis by paralysis by analysis.
Yes. Yeah. Whereas in the old days was a lot simpler. You didn't get the news right away. You even had instances where a news report would come out of Tokyo or Japan, which would affect the value of the yen, and the Japanese traders would tell all their friends in Asia or Australia what the translation was, because you had this thing called the GG facts, which was just Japanese news. It was coming out, and people needed to know
exactly
what that said.
Yeah. So nowadays, having more information is actually harder to deal with. So what would be a recommendation from you to perhaps someone who's new or struggling with this to sort of restrict their information intake so that they can focus on what really matters?
That's a good point. I guess you just have to try and, through experience, get your fundamentals, get your technicals, and just filter the news. Filter what's being said, filter what's happened yesterday and the day after, and just build your arguments, build your case for the pluses and minuses. Let's say in the currency markets.
So almost make pros and cons list in some instances.
Yeah. You build your own on the knowledge that you have. Get to talk to other people. Like we're talking as well. Get ideas from other people and just build your own. So it's about building and sort of putting some parameters in place that allow you to sort of filter out the stuff that may not be as impactful as you think. Obviously, Trump tweets 99.9% of the time, and then things like that. You would look to try and sort of just go, okay, well, what's really the bigger piece of news here that's going to have an overarching piece of movement? Okay. Well, I mean, what I suppose moving on from where we got started, what do you feel is the likely outcome for 2021? First of all, I think this election is going to be big. You're going to get a lot of volatility.
So you're talking about the Joe Biden, President Trump in November one?
Yes, this November election in the US.
Yep.
Again, I think regardless of what the outcome will be, there'll be a period of volatility going into
and out of?
I think you probably have the volatility going into 2021.
Yeah.
And maybe see it for the next 3 to 6 months. Again, depending on COVID. You know, are we going to get a vaccine, or is it still going to be the same?
Well, I mean, that's the thing. It's been the same backdrop for 8 months, hasn't it?
Exactly. And no one still knows, you know. I mean, all that excitement we were talking about earlier about a vaccine possibly coming in and what it did sentiment in the markets.
Well, I mean, I suppose this is very relevant to today. I mean, even just this week, we've seen those big drops in equity markets, particularly US equity markets, where, and it's been different because it's been more on the cyclical side of things than it has been on the tech stocks. So that sort of says, to me at least, that, you know, whilst we've got companies that, you know, should be improving when a vaccine comes, everyone's been banking on this idea of a vaccine coming. And of course, you know, COVID starting to ease, and we've been hearing the signs of things out of like Sweden where they're like, oh yeah, we're starting to get herd immunity. But then you get this report out of the UK that says, well, we think we're in trouble. We might be seeing 50,000 cases a day within the next week. And everyone goes, oh, okay, maybe we're a bit early on the cyclical stocks. Let's rotate or rebalance where we've got our risk to something that's going to keep us growing. And that's the best way I can actually see that that's really happening. Do you agree with that sort of line of thinking?
I totally agree.
Okay.
You know, and I think that you've just got to you know, try and ride that wave, and again, you know, build your own case. When I started trading, I would always get a specific currency. For example, take the Aussie. And just get a piece of paper and draw a line in the middle, and then put a plus and a minus. The plus is the factors why I should be buying Aussie. The minus, the factors why I should be selling Aussie. You just have a mental sort of.
And so, I mean, I suppose this is probably going a little bit political. When it gets to the election side of things, do you see a benefit to either party for trading communities?
No. I think if the Conservatives, you know, let's say Trump stays in, probably a little bit more stability
towards stock markets and things like that. Yeah,
toward the asset markets.
Because I mean, he's always been very much on that side of pushing the stock market higher and getting better prices, whilst I know Joe Biden has always had an interest in sort of increasing regulation on the Wall Street side of things. So, that's in line with what we're all thinking. I think generally it's going to be an interesting couple of, like, you know, next month and a half. There's also the potential that Trump decides, even if Biden wins, that Trump decides, no, I'm staying. So we might find America, we might find the US in a civil war when we wake up in November one night.
Do you remember 2000? When you had Bush and that recount all the way up to in Florida, all the way up to January. So it was in November, and that who was his opponent? Al Gore.
Al Gore.
That's right. And the markets were just in limbo at that time. I remember that. I was in the NAB trading room.
I mean, if an event like that happens, then obviously we have to expect some sort of sideways and consolidation sort of movement, because no policy is going to move forward. It's going to be very hard to get any bills signed up upon, and it'll be just a turbulent time in general for that front.
I think the dollar will probably come under a lot of pressure. Because again, you know, they have that question.
So I suppose we're starting to sort of get towards the end of the podcast today. I've really only got sort of 2 final questions for you today before we sort of wrap it up. What would you recommend to someone who is new to trading?
Well, get to know about what you're getting into, what asset class. If you're doing shares or indexes, you know, get into the companies, know about the markets, read about people who have actually traded the markets. If it's in foreign exchange, just the same thing. Just get as much knowledge as possible.
Consume absolutely everything available to you.
Yeah.
And is there anyone that you would recommend that they follow, or any sort of plans of action? You know, what might you do on your daily basis to say, you know, I do this every single day, do this every single day? What would be one of those sort of things?
Okay, I'm a guy who likes to look at levels. Especially in foreign exchange. Every day I get up and I have about 32 different instruments, including currencies and some of the indices, and just get the opening, the Asia opening, and the high and low overnight, and the range that they traded in overseas markets. For example, the euro, the Aussie, and go all the way down, and that's always guided me in my trading. You know, almost always Asia will probably consolidate the levels it traded overnight. And if you see a break, you look at technicals, you see a break one way or another, you might find a move.
Okay.
Which might be happening.
So there you go. Have a bit of a go at the Asian session there, guys. Now, the other one last final one is, what do you think are some significant opportunities or challenges that the industry as a whole, the one that you've been operating in for most of your career, is really going to be facing over the next say 1 to 3 years?
Well, I think a lot of it is, again, the regulatory regime. Again, they're going to be over-regulated or under. A lot of them also would be the response of the different central banks as to what's going to be developing in the markets. And then there's this retail side, which we haven't had a flash crash in a long time.
Yeah. What about March? Does that count?
Yeah, I guess you could consider that
I mean,
one
there's
little
a
one.
flash crash that took about a week. So
yeah,
it's
it
not
took
like,
about it's not like that. Yeah,
Yeah.
but one of these type of events, there's still a real possibility of that happening, which most traders love. When that sort of happens, you get that.
Banks hate it because all their clients make money on the flash crash, but
there
there are some people who don't like short sellers, but I'm not one of them. I don't mind. I go both ways. I don't really worry about whether it's long or short.
So there's a lot of challenges in the days ahead, and for those, I have younger guys and retail guys, and some of them, because they've actually lost employment, they're just going online and starting to see, I can just stay at home, and trade these things. But get to invest a lot more first before you start. Just picking at levels and everything. Yeah.
So learn before you actually play.
Yeah. There's an investment period where you need to learn. Yeah.
Excellent. Yeah. Michael, thank you very much for attending the program today. I'm sure our listeners have gotten a lot out of it.
Well, thank you, Alistair, for having me. It's been a privilege and a pleasure. And I'd love to come back anytime.
We will aim to get you back. And on that note, the next chance we get to get Michael in, we will certainly do it for you all. Now, if you would like to get in contact with either me or Michael, then please feel free to shoot me an email at talktoal@acy.com. And of course, don't forget to like and subscribe so you can get more great vlogcasts from me and ACY Securities in the future. Have a great trading day ahead.